Morning, Richard.
Morning. Hi, James.
I don't know if you saw my message. We didn't actually get your slides. Do you mind just switching them over again, please?
You haven't got them? Yeah, okay. Yeah, I'll send them
But I
over.
can hear you loud and clear, so that's the main thing.
Yeah,
Uh,
can you see me?
we don't need to see you. That's fine.
Okay.
Cool.
Yes, let me do that. I'll get them
Very
over
good.
to
All
you.
right then. So if you just go back on mute again, we'll run to the news first, and then we'll get to you.
Yeah, okay.
Thank you very much. Cheers. Okay, it's 11 o'clock, so we'll get going. As those of you who are already listening will know, I'm talking to Richard Hulf of HydrogenOne Capital Growth later on. But before we do that, there's a bits of news to talk about. So I'm going to be talking about Brunner, which had its results this week. It wasn't a particularly, this wasn't an awful lot going on, but in my part of the world anyway. But I think Brunner's interesting and worth having a look at. And then Richard's going to be talking about Richard Williams here is going to be talking about Tritex Big Bulk REIT and the UK commercial property deal. So we'll see what he's got to say about that. So Brunner first. This is a decent size global fund on about a 10 discount, which is wide-ish, I think, although as you can see, it's sort of narrower than it has been for a while. It's not really obvious at the moment why its discount is wide. There was a long-running thing, we go back a while ago, that it had very expensive debt, and that there was a good reason for it to be trading on a wide discount. But that's all sorted out now, I think. So there's no really good reason for that discount, and that's why I wanted to explore a bit more about what's going on. Within the peer group, there's lots of big funds in the peer group. It's still a reasonable size, obviously, £500 million. And the ongoing charges ratio, it's not the most competitive, but it's still, that's not outrageous, 0.6. It does offer a dividend yield. We'll talk more about income in a minute, although it's not massive, and that's not the main reason to own it. It's been going for quite a long time. It's interesting because it's another one of these kind of family vehicles. So it was founded originally with the money that a family got from the sale of the HydrogenOne business into ICI back in 1926-27. And the family still got just shy of a quarter of it. One of the things that they're trying to do at the AGM now is to see if it's okay to buy a bit more shares and sort of get a creep and control thing, so that percentage might go up if they don't sell. And they're obviously quite sort of wedded to it. One of the directors is normally somehow connected to the family. At the moment, one of them is married to a family member. It's got a long record of dividend growth, so it's an AIC dividend hero, and you can see that here. And actually, you can see the effects of this slow compounding of returns of dividend income. So this is just the dividends going up here, but it's way ahead of inflation over time. And I think that's really part of the whole thing about why these global growth funds are actually worth thinking about still. And crucially, I think for their marketing message, that they've now outperformed their benchmark for 5 consecutive years, which is not bad going in an environment where lots of active managers have struggled. But as we'll come on, the benchmark that they're using is not the same as most of the other funds in the sector. Now, I think one of the reasons why it might be out of favour is that it's had an awful lot of manager moves in the last few years. So that 5-year track record is not the sole responsibility of the current managers, because Lucy McDonald, I think everybody loved, left in May 2020, and that was a bit of a surprise. But there was lots of internal shenanigans going on in Allianz, and that's what happened. And then Matthew Tillett, who took over from her, didn't last that much longer, so he went off in July 2022. And they promoted somebody internally to be the co-manager, and then they recruited externally to be the other co-manager. And that happened in November 22. So you've only really got about just over a year's, well, actually, I mean, these are we're going to look at the end of November 23 numbers. We've only got really a year of the new guy in. But the underlying thesis hasn't really changed. over that period, and maybe that consistency is something that you can sort of relax about. It's supposed to be kind of like an all-weather fund, so it's not a growth fund, not a value fund. The weird thing, the saying about the benchmark, is that it has a big bias to UK, and that's an anachronism. That a lot of these funds used to do that, but not so many of them now. And the rationale was, if you're a UK investor and you're investing in these things, it makes sense to have a lot of money in your home market. But that seems to have generally gone out the window now. But this benchmark is still 70% FTSE All World ex UK and 30% FTSE All Share. The weighting of the UK within the All Countries World Index is about 3.5%. So you can see there's a big difference here if you construct your portfolio to look like the benchmark. They say they don't let the portfolio, the benchmark influence the portfolio, but they do maintain this big UK bias. You see that's 24.6% of the fund. That's at the end of December. It's a fairly concentrated portfolio. It's all put together on a stock by stock basis, so they're not looking top down at sectors and country weightings. There's obviously this gearing thing that they've had for a long time going on, but it's quite modest. They're focused on the sort of high quality, high return on equity companies that reinvest their cash flows, solid business models. And the idea is, if you get something that's compounding its earnings at sort of 15% or something, then the value of that over time means that you can afford to pay up for it now. So they're maybe sort of buying things that may be more expensive than you might do otherwise. And so they're not as bothered as some people might be about the opening valuation of these stocks. Now, this is what's driving the returns for them for the year to the end of November 23. And it, as I say, it was quite a remarkable achievement to beat even their benchmark, given what was going on with the rest of the world. As we know, there was a kind of magnificent seven of AI-related stocks that really drove markets and big mega cap things. If you didn't hold them, then it was a real struggle to keep going. And the fact that they've only really got their Microsoft up there at the top, that does tell you really that their other stock P must be not bad. And you can see there's lots of unusual names in here. So Novo Nordisk is something that I think a lot of people hold. That's the company that's making the Wegovy weight loss drug, and that's got metal on the back of that. But there are some bits and pieces here that you might not recognise, like the Baltic Classifieds thing, and Jumbo, the Greek retailer. So yeah, I think that just the indication that maybe they are quite good stock pickers. Things that not everything goes right with them. That's sort of natural for all these things. But not holding four of those magnificent seven, I think is yeah, that just shows you the achievement they made this year. All gone and good. So this is what it stands up like here within the sector. So I've ranked this by 5-year NAV growth. This is all annualized, so this is 11.5% a year. And it ranks second, so which is obviously pretty cool. Number one still is Scottish Mortgage, despite the really torrid time it's had more recently. So those numbers are sort of coming down to meet these ones. Alliance Trust is still up there. And I think it's important to recognise that it had a much better year than Brunner last year. But this is the difference that the benchmark makes. So if it was trying to beat the world index, instead of beating the benchmark every time period, as it does almost there, well, apart from just about matching it over 10 years, it would have definitely struggled a bit more. It still would have done it, but not by as much. And the fact that it's underweight, so maybe it had 24.6% weight in the UK against 30 for the benchmark, that UK underweight alone would have accounted for a big chunk of its outperformance of its benchmark. So I'm slightly thinking that I do like it. And if you read the annual report and accounts, I mean, they really go to town explaining what they're doing and why they're doing it and why they hold the stocks they do. It really should be commended for that. But it's not as great, this sort of 5 years consecutive performance as it might look first on paper. So there, that's enough from me. I'm going to hand over to Richard.
Great, thanks, James. Yeah, so all I talk about at the moment is mergers in the real estate sector, and there's another one this week, or a proposed merger. So this time it was Tritax Big Box REIT looking to merge with a UK commercial property REIT, which for those of you who follow the commercial property sector doesn't really tally that well with, if you look at the portfolios. But we'll go into more detail about that in a minute. I'm not sure what's happened there. There we go. So yeah, so like I said, all share merger proposed by Big Box. If you go back one, yeah, there we go. So each UK commercial shareholder will get 0.444 Big Box shares, which values the company at just under £1 billion, so about 924 million. That's a premium to their share price. As we know, all property companies have been struggling share price wise, so no surprises there, but almost 10% discount to their NAV at the end of last year, so maybe a bit of value still on the table there. So on the next slide, yeah, this is really interesting. So UK Commercial's chairman, Peter Gray, is not supporting the deal at the moment, and that if you looked at the announcements on Monday morning, two very conflicting announcements from Big Box and UK Commercial. UK Commercials was released on Friday evening, but only came out Monday morning, so it was a bit puzzling when they both came out together. But yeah, the rest of the board is for it, but apart from the chairman. So I mean, this is me speculating here, but I'm thinking maybe he wants to keep a diversified approach. The UK commercial property, as we'll see in a minute, is the biggest diversified sort of traditional generalist property company. So it would leave a big hole in that sector for investors. And also he supported the merger proposal last year from Picton, which would have been more of a better marriage than this one portfolio wise. But it did reveal that there have been several approaches from Big Box for this deal. And more importantly, UK Commercial's largest shareholder, which is Phoenix Life, which owns 43%, is in support of the deal, as is their second largest Investec. So about, what's that, 56% are for this deal. So which tells you it's probably gonna go through. But interestingly, to note that so UK Commercial's manager is Aberdeen, which also owns 60% of Big Box's manager, Tritax Management. And Aberdeen also holds a big stake in Phoenix Life there. So it looks like it's all going to be sort of kept in house with Aberdeen. If you've seen the news recently or over recent months, that they're likely to lose their other fund, Aberdeen Property, which is going to merge with Custodian, and their European logistics fund, Asley, is also put themselves up for sale. So we'll see what happens there. That could also merge with another Tritax fund, Tritax Eurobox, but we'll see what happens there. So I just put up their peer groups. I've ranked UK Commercial by market cap, as you see there. So like I said earlier, by far the biggest UK commercial diversified REIT. Obviously LXI is merging with London Metric. They're more of a sort of long income stuff. Supermarkets is obviously supermarkets. So as you see there, it's the biggest market cap, and that will leave a big hole in that sector with balanced commercial BCPT, sort of £500 million, and then you've got really small companies there. So that would be a shame for that one to drop out. Tritax Big Box, you can see there, almost 3 billion market cap. We all know about how big these guys are. And you see performance over the last 5 years on the next slide. So this is UK Commercial. This will be pretty similar to big boxes on the next slide as well. Massive, doing well, and then a massive fall off in NAV and share price sort of middle of last year as interest rates started to come up, or sort of end of 22, sorry. And the discounts are widened, and this is why we're seeing a lot of this M&A activity at the moment. So we look at the joint portfolios, UK commercial about 60% in industrial and logistics. Big box obviously fully focused on logistics. It's got about 7% in development. So combined there'll be about 6.3 billion, 290 million in rental income a year, and almost 4 billion market cap, which would make it the fourth largest UK REIT. And this is what I assume will happen, and probably will happen. They sort of alluded to it in their announcement that they'll sell off all the non-logistic stuff, about 500 million, and it will fund their development pipeline going forward. So they've got about just over 7 million square foot consented, ready to go. They usually deliver about 2 to 3 million a year in new developments, and that produces about a 6 to 8% yield on cost, so about 6 to 8% return on what they're spending there. So it does make sense in that regard to fund this. There's no other. The traditional routes of raising money is sort of not open to them at the moment with the cost of debt and being on such a wide discount. So this does make sense in that regard. But like I said, it'd be a shame to lose UK commercial just for their size in that diversified generalist sort of REIT sector. So, but we'll see what happens over the next few weeks and months.
Cool, thank you, Richard. Yeah, I think it probably is just designed to get them to fund their pipeline because they can't raise money to do it otherwise. But yeah, there we go. Now, as you probably saw, sorry, I thought we were looking at the wrong screen. We do have a presentation from Richard that I shall now switch over to. Make that full screen. Hopefully we can all see that. And then Richard, good morning.
Good morning, James.
So thank you very much for doing this again. Obviously, we're all keen to see what's been going on with the fund since we last talked to you.
Yeah.
But for those people who don't know it so well, perhaps you could just sort of start off by introducing what it's trying to do, please.
Yeah, sure. Thanks very much. We are the only listed exposure that we know of to the hydrogen market in the UK. So this is a growth fund. We're looking to put a pound or a euro or a dollar into a company that is in the engineering business that makes a fuel cell electrolyzer, and then exit from that business in sort of 2 or 3 years' time and make sort of three to £5 or dollars. So it's about capturing growth in this sector. We're looking at the industrial sector of hydrogen. This is not about retail. We're way off a retail market for hydrogen at the moment, and so that's essentially it.
Cool, thank you. And then what we have here, I think, is some highlights of how you've been performing recently. So do you want to sort of talk us through this?
Yeah. Do you want to go on to the first slide? I can't see anything on my screen at the moment. Just the legal bit.
Hang on. Maybe I am not sharing what I think I'm sharing. Let's hold up. There we go. How's that? Better?
Yeah, got it. Okay, thanks very much.
Apologies.
Yeah, so we're really pleased to see NAV per share rising. This is for Q4, nearly 2%, just over £1 per share, and NAV now at 133 million. Portfolio continued to deliver strong growth. Its private revenues were 125% over the year to a total of 74 million, reflecting all of the investments in the fund. This is 98% of the fund is invested into the private companies and projects. So investments in Q4 totaled 1 million in 2 follow-ons. In terms of valuation, the holdings are sort of in line with listed hydrogen names at the moment. We've seen new strategic investments into 2 portfolio companies, new equity and new industrial collaboration, and we continue to see strong and improving industry fundamentals and a sharp increase in sector investment despite the difficult macroeconomic background that we're all experiencing. So that's sort of like a summary slide of performance in the Q4. If you could flip me onto the next slide there, James. Let's just explain a little bit about what's actually going on in the hydrogen sector, sort of a quick overview of the opportunity. So we're taking renewable green electricity and we're splitting water into hydrogen and oxygen, essentially. And then we're using the hydrogen and we're using renewable electricity to make green hydrogen. You've heard other colors of hydrogen. Blue hydrogen is basically heating up steam and methane to a high temperature and then capturing the CO2, then it becomes blue. There's a bit of that in our pipeline, but really we're focused on the green hydrogen. So the hydrogen gas is then an energy carrier, which can be stored over long periods of time and moved around, and we're investing into all the parts of that value chain. So you can use the gas in industrial processes, in refineries and chemical plants for making steel, for making cement. It really is the only option for decarbonising. Or you can convert it back into electricity with a fuel cell, as you can see in that vehicle down at the bottom there on the right-hand side, or you can use it for off-grid power. So all of this is to replace polluting fossil fuels and hence avoid greenhouse gas emissions. So that's like a summary of the process itself. And then next slide, please, James. So let's take a look at the what's in the fund itself, and that's at 133 million of NAV. So we've got 10 private positions, concentrated portfolio, high conviction positions. The top holdings are about 90% of the NAV. Where do we invest? Revenue generating supply chain companies, meaning engineers, companies that make stuff. They make fuel cells, electrolyzers, they make the storage cylinders, they make the pipes. But you also invest into developer companies. These are companies that actually make green hydrogen. They're people that buy electrolyzers. So that's Gen 2 and HH2E that you can see there. And we're co-invested into these positions with strategic industrials and other institutions. And we'll show you a few names in a moment, just to give confidence about how seriously the industry is taking this new form of energy. But we look for portfolio diversity, means global allocation across the value chain from the upstream of making hydrogen all the way down to the downstream in companies like Cranfield, who are using fuel cells to generate electricity for aircraft and flight. So a clear exit strategy, which would be via IPO or trade sale. Fund's been around for 2 years, so we're now entering into that window now. Take me on to the next slide there, James, and I'll take you through who else is invested into these companies that sit in our portfolio. So you can see down the left-hand side there, each of the companies, and the right-hand side there, some familiar names. People like Shell, Vitol, Centrica, growing their hydrogen businesses, and ESG funds like Amazon and Planet First. So this is a great tick for the sector in terms of investors that are taking it seriously. I suppose we would like to see more financial investors coming in, and ultimately this becomes a listed market. We think it's too early for hydrogen companies to be listed. Listed markets are looking for regular revenue and EBITDA growth. We're sort of at the early stages of that, where it's not quite so predictable. So we think the private space is where you get the maximum growth in the sector, and that's what these strategic investors are looking for. The next slide, please, and we'll just get into some of the Q4 financial highlights. So we use IPEV guidelines for these numbers, which are reviewed and approved by the board, and annually they're audited by KPMG, our auditor. NAV per share just up slightly on the quarter and up 5% on year. This is mostly using discounted cash flow models, and on average we're using a 14.1 discount rate in the quarter, and down slightly from Q3, but higher than a year ago. If we look at the effect of NAV overall, NAV per share reduced by 6.7p year over year, just due to the discount rate increases. We made a £1 million investment in the quarter into Strohm and Gen2. Strohm make TCP pipes. Gen2 Energy are a hydrogen producer in Norway. This follows follow-ons alongside other lead investors that we showed you on the previous slide. Overall, this leaves cash and listed shares, a very small part of the fund, at just under 7 million, meaning the company's in a robust cash position going forward. On the next slide, let's look at NAV growth. We saw a rise in valuations in multiple private positions, totaling around 2.7 pence per share, but offset by fund costs. On a long-term basis, on the right-hand side, our NAV per share has been steady and rising since the mid 2021 IPO. You can see additional cash coming in June 22. And we'd characterize this as organic growth as the portfolio companies grow their businesses with our investment, with small ups and downs on the NAV due to listed markets and discount rates. So respectable bottom line performance as the fund completes its first investment phase. What's not in these figures is the impact of exits. So that's what this fund is all about, generating returns from exits. This is the steady as she goes NAV increase of the sector, despite the headwinds of higher discount rates. But we're moving now into the window of exits from some of these companies where we'll start to see multiple returns. Look at the valuation changes on the next slide. This chart breaks down the NAV growth by company on more detail over the year. This is the whole HGen portfolio, and we're looking to give our investors a high level of transparency here by showing you each of the companies. We've seen increased valuations in multiple portfolio companies as a result of growth delivery, despite an increase in discount rates as well. So the fundamentals of the sector are very strong. So overall, this was a NAV reduction of just under 9 million per year, just on the discount rates alone. But these are absorbed into these numbers and counterbalanced by the organic growth of the portfolio itself. On the next slide, let's get a little bit into detail of some examples of how the fund breaks down. Private assets dominate, as I said, 98% of the fund at the end of Q4 were in these private positions, as shown on the left-hand side by theme. So you've got the hydrogen producers, the hydrogen users at the sort of the downstream part, and a large part of the fund in the supply chain and storage and distribution. And in terms of geography, although quite a lot of the fund, just over half UK domiciled, most of those UK companies are selling their product internationally, and particularly into Europe. And on the right-hand side there, you can see the actual NAV breakdown with some of the larger companies like Sunfire and Elcogen. These are companies with hundreds of staff and large factories developing, and it's about production growth and scaling in the hydrogen sector on the right-hand side there. And so portfolio diversity, it means it's global allocation across the whole value chain. Why don't I give you an example of one of the companies that featured in news flow in the fourth quarter, and this is HYROC. Now, interestingly, what HYROC do in that process, you can see there on the left, is that they don't split water; they split methane into carbon and hydrogen. The carbon is very useful to be used in the tire industry and fertilizer industry, but it's got great applications in energy transition from oil and gas companies and other industrials looking to stop flaring gas. What they've been doing over the last couple of years is testing and certifying the product, and you can see that going on the Centrica Brigg site in the UK on the right-hand side there. This is of great interest to a lot of industrial participants. Cemex and EPI are now trialing the project the product at scale, and will be manufacturing at scale towards the end of the year and into next year. And so real sort of revenue and earnings growth coming in this part of the sector. This is thermal plasma electrolysis, TPE, which is now being classified by the UK government to qualify for financial support as a green hydrogen production technology. So that's HYROC. On the next page, we've got Elcogen. We've invested 20 million into Elcogen back in 2021-22. We own just under 10% of the business. Successful grant funding of 25 million euros, and Hyundai investing 45 million euros that completed in October, bringing in an important strategic investor. These are fuel cells that are solid oxide. It's a specialist form of electrolysis and fuel cell technology that works at high temperature and is very, very efficient. The investments that came in from the grant funding and from Hyundai are being used to develop factory that's on the right hand side there, to meet 100 megawatt capacity, to meet demand for this fast moving technology. The investment by Hyundai also comes with strategic intent to set up manufacturing joint venture in South Korea as well. So this is an industry that's moving fast and moving at scale. So that's Elcogen. Let's just look at revenue generation in the portfolio since investment. On the left-hand side there, you can see revenue growth by company since we invested. The earlier investments into Bramble, Sunfire have so far grown sort of 10 to 14 times since investment, so all moving in the right direction. And some of the more recent investments into HYROC, Strohm, and Elcogen at the bottom there have grown 1 to 6 times. Revenues in aggregate on the right-hand side there, on a 100% basis, generated £74 million in revenues in the last 12 months, up 125% from the equivalent period in Q4 22. So the growth is real and the growth is accelerating. So that's just like a sort of snapshot of the fund. I can just round off by saying, well on track this quarter with a robust NAV liquidity of about 7 million. We're in a good position. NAV is 103p, up 1.6%. Sequentially up 6% year on year. Portfolio up 2.7p from multiple private companies. Revenues up 125% to 74 million. Overall, all on track, delivering the growth the value was set out to do. Next steps will be exits from the portfolio, real value creation, and that's the window that we're working into now, and that's going to be the news flow for 2024. Thanks very much.
Great, that's really good. So we got a few questions coming. I'm sure there's be more in a minute. Let's start off with where the fund's invested. So geographically, Germany, UK, Scandinavia, and Netherlands. Is there a deliberate focus on kind of like OECD, developed world type stuff, or would you look at emerging markets in time?
Yes, it is. It is deliberate. We in actual fact, technology risk is pretty low in this sector. Electrolyzers, electrolysis, as a principle, has been around for decades. You know, first started in the 30s. So, but we don't want to overburden investors by thinking about technical risk and political risk as well. So, we're staying out of the more politically sensitive areas. And besides, most of the funding is going into Europe, the US, Asia Pacific. So there's no real need to go into emerging markets. But you're right, James. Yes, it is just an OECD focus.
Fair enough. And then on the sort of methodology, there's a question specifically about nuclear powered hydrogen. Does that make sense? And would you do that?
It totally does make sense. It depends how you regard and categorize nuclear energy. Sometimes called pink or yellow hydrogen. All it is it's how you produce your electricity. It goes into splitting water into carbon into hydrogen and oxygen through electrolysis. So it's still an electrolysis process. It's just where do you get the green electricity from? So potentially, yes, if we came across a project that could deliver returns for shareholders in a timely fashion, yes, we would do that. The trouble is, I mean, I'm a mechanical engineer by background. And I worked on nuclear power stations years ago when I worked at Babcock Power. They take a very, very long time to come to fruition. and I don't think it would kind of meet the timescale of what we're investing into in the hydrogen fund compared to electricity from wind and solar.
And then in terms of the sort of technology of making it in the first place and the fuel cell technology, are there developments coming along that might revolutionize some of this, or is this sort of pretty much how it works now?
Well, it's pretty much been revolutionized because it's the speed at which you move water through an electrolyzer and the pressure that you move it through that requires advanced computing and control systems that has been the breakthrough since electrolyzers were strolling along back in the 1930s. So in principle, it's an old technology, but it's the way that it's being handled now. So in an electrolyzer, it's a stack of plates, anodes and cathodes, electrodes. That's the old stuff. But a complete electrolyzer is a lot more than just the stack. It's also the compression, the control systems, the pumps and the flow systems, and that's what companies like Sunfire specialize in making for industrial applications. I think the solid oxide is the way is the coating that goes onto the plates, the materials that you use in the electrolytes. That is advancing fast, and so at the moment, most of the world's electrolyzers and fuel cells are alkaline based in the electrolyte, but it's the solid oxide move that's coming. In fact, one of our companies, Bramble Energy, doesn't make the plates out of metal. It makes them out of printed circuit board material, PCBs. So I suppose what I'm saying is material science is having a great impact on the improvement in efficiency and cost of these technologies.
Right. Okay, that makes sense. Thank you. Now, you've got a bit of cash and you've got the listed portfolio too.
Yeah.
So firstly, can you explain a bit about what the policy is around how much liquidity you want to have?
Yeah.
And how you manage it going forward?
We're sort of comfortable where we are on liquidity. We don't want to go below this number. We are turning more of that listed portfolio into cash, but we're just entering the window now where you'll start to see exits from some of these positions. And I can't say which for obvious reasons, but two of these companies have recently appointed investment banks to manage the exit, to manage the sale process. These are not going out at the moment as IPOs for obvious reasons about the IPO market's pretty dead. This is strategic investors, people that have been left behind in the process that are entering into the window. So there's cash coming from that's the main source over the next 6 months that will top up the cash from where we are at the moment. But we're sort of happy where we are. We wouldn't want to be much below this.
Okay, fair enough. And then within the kind of listed side of things, will there ever be companies that are listed that you want to hold? Or is the strategy all about the private stuff?
It's all about the private stuff. The reason that we started with some listed stocks in the portfolios, we simply wanted to have a window into valuation methodologies and to understand how the market sees the hydrogen sector, because potentially some of the exits from these private positions would be into listed into the IPOs. What's actually happening at the moment is most of the exits that we're potential exits that we're seeing are through trade sale, and so it's less important for us to be in the listed market. But yes, I mean we specialize in the private companies and we're well known in the private market. But there's no reason if we didn't see an interesting new IPO or a company that was pre-IPO. If it gave us our sort of multiple of return on upside, then there's no reason why we wouldn't do it. But we're less likely to see that compared to the privates.
Yeah, okay, that makes sense. There's a couple of questions about debt and gearing. Can you say, I mean, are these companies, are they any of them debt funded?
There's very low debt funding in the supply chain companies that make the engineering businesses. there's absolutely going to be quite a bit of debt that comes into companies like Gen2 and HH2E, because these are this is project finance. So we own shares in the topco Gen2 and HH2E, and the projects that they develop. And it's an interesting point that you've raised. We'll have hundreds and hundreds of millions invested into those projects, and then typically project finance is going to be sort of 40 to 60% of that is going to be debt at the project level. So the interesting point, though, is that there's enormous value upside in these projects, which under IPEV guidelines we cannot currently reflect as value in the fund. Only when those projects get to FID, final investment decision, and we will be entering into that period with both those companies this year. So you will see potential quite sudden movements in valuation as those projects come into the valuation spectrum.
Cool. We'll talk about them a bit more in a second. But before that, would you ever borrow money within the fund?
We are looking at borrowing money. I mean, we're limited to a 25% gearing ratio. We would never go anywhere near that. It could be interesting for us to use it as a revolving credit facility. So from when we're between sort of funding cycles, but we would try to keep that at an absolute minimum. So we're looking at it at the moment, but it's never going to be a big feature of the fund.
Okay, fair enough. And so just some questions about HH2E. So maybe you can talk about both of them. So as you say, so these are kind of like project managers, if you like. They've got sites identified and sometimes customers identified, and so it's just a question of getting these big gas production plants built.
Yes.
How are they going to get financed? Is it going to be government money, or is it going to be investors, or?
We are in the middle of those funding processes. At HH2E, we've already announced that BNP Paribas has been appointed as the advisory bank to coordinate that debt and equity that goes into those projects. We haven't yet announced which bank is doing it with Gen2, but we're doing that at the moment. We have a Gen2, though we have announced the hydrogen offtake agreement. Heads of terms have been signed with CEFE, the sort of German government body. So both projects are entering, both companies are entering into their first projects this quarter 1, quarter 2, 2024, and the banks are being appointed, and that debt and equity split is being arranged. So we have rights to invest into those projects, and we're looking at trying to raise capital separately to do that. Very much tricky for us at the moment, given where the share price and the NAV are. But the valuation uplift is very, very tangible here as we move into this next phase of those projects being financed.
Yeah. Okay. Great. I mean, and then I suppose the back of my mind, and that sort of alluded to here, there's a question about the election and whether that's here in the UK when that's going to make a difference. It does feel sometimes like the European governments are a lot more committed to this idea than the UK one is. Is that a fair assessment or not?
Yeah, it doesn't just feel like it. There's actual evidence for it. Yeah, because I mean, the UK hydrogen sector indirectly had a bit of a setback when the government said, okay, so internal combustion engines, we were going to ban the sale of those in 2030. Let's make it 2035. So so the switch at the HGV heavy end of the sector, transportation sector, to move from fossil fuels to hydrogen has had a bit of a setback, and that hasn't happened in countries like Germany, France, and Italy, where the government has gone in the opposite direction and advanced even more capital into funding these projects. So in Germany, for example, by law, you have to have hydrogen refueling every few hundred kilometers on the new autobahns. So yes, but at the same time, the UK has committed to a number of green hydrogen projects and put some funding behind. But the funding is relatively small compared to the billions of euros going into projects in Europe. So but it doesn't really matter to us because I mean there's some short-term setbacks for the hydrogen transportation sector, but our companies and our investments will just go where the returns are for our investors, which at the moment is mainland Europe.
Yeah, fair enough. Does the economic environment have much of an impact on this, or is the so embryonic it's just going to sort of carry on growing through it, whether there's sort of like recessions or not?
It's a good question, James. This particular fund, compared to other investment trusts, is not as affected by movements in interest rates and discount rates because this is not about yield. This is about growth, and the growth equation sort of transcends the current economic environment because if you are a global utility or a global energy company, a global transportation company, anybody that's in a hard to decarbonize sector like steel, like cement, like backup power for remote information centers, that's all got to come from hydrogen. And the investment horizon for industrials is 5 to 10 years. So we may be in recession now, it may be out of vogue. You're not going to see hydrogen on forecourts of stations, but that doesn't really matter because it's about the industrial movement which is going on in the background, and that works on a different timescale. So and that is where we will see exits from this fund through people that are large industrials that just have to do it. There's no choice. Investors shouldn't get the impression that hydrogen is going to revolutionize the entire primary energy chain. I mean, by 2050, when hydrogen is completely integrated into the process, it will probably only be 10 to 15% of the primary energy mix. But given what a fraction it is at the moment, there is enormous growth potential by investing into this sector.
Yeah, exactly. Can you tell us a little bit more about Cranfield, please, and how it's doing with the hydrogen-powered flight?
Yes, Cranfield is one of the technology leaders. The great thing about Cranfield is that when Airbus or Boeing want to get something done in the aerospace sector, they need to get it certified by Civil Aviation Air Authority. They'll go to Cranfield to do it. So Cranfield are the best people to get certification for hydrogen flight. So they are working with a number of light aircraft makers. They are not aircraft manufacturers themselves. A number of drone companies like Dronamics that want to switch over their drones and the aircraft companies, their light aircraft, to running on hydrogen. So how does that work? Well, it's in the short term, it's about turboprop propellers being driven by DC motors that are you can't put batteries on an aircraft or a drone. They're just too heavy. You have to use hydrogen. And so that's what they're doing. They are developing our co-investors, Safran, the French aerospace company, SDF, the large sort of state sovereign wealth fund from the Middle East. We're funding the development of these light aircraft, and we hope to have these certified and in the sky within the next sort of couple of years. How do we make money out of that? Probably not by Cranfield itself building large factories and building these aircraft, but by as soon as they've got that certification, they've got the lead, it's likely to be an industrial takeover. And we know that there are already interested parties in this space. So that's the Cranfield business.
Great. Okay, thank you. Now you've got one of the HH2E projects on your portfolio now, the Tierback.
Yeah, Tierback, yeah.
Would you like to have more of them and Gen 2 energy projects as they come?
Yes. I mean, just to give investors a rough feel, when we've shown this in previous slide decks, both Gen 2 and HH2E have got 5 to 10 of those projects in their portfolios. It just so happens that the Tierback project is the most advanced at the moment, so it's been sort of separated out as a separate item. But absolutely, we do intend to carry on. So in a couple of years' time, Gen 2 will have 2 or 3 of its projects under development. One of them will definitely be on stream by then. So absolutely, yes. And we may have to look to private funding options, but hopefully we can sell some of those project interests as well. But there's no value for those projects currently reflected in that NAV, but that will be coming quite soon.
Great. Okay, thank you. Now, Strohm, I think it's got like a sort of pilot project. So there's the idea that you can use an offshore wind turbine to generate hydrogen at the turbine and then pump the hydrogen to shore.
That's absolutely
more
it.
efficient than sending it down a cable.
Yes, absolutely. So you just put an electrolyzer on the wind platform. So you're just moving the electrolyzer much closer to the source of electricity, because the electricity losses that are suffered along cables along the seabed are much higher than turning it into hydrogen. So you've got the choice when that comes to shore. So Vattenfall and Ørsted and companies like that are running these projects. You can either then put the hydrogen directly into the hydrogen application on shore, and this grid blending that now going ahead in Germany, and in the Netherlands, separate pipeline networks for the hydrogen. Or you can turn it back into electricity by putting that that hydrogen into a fuel cell, which is the exact reverse of an electrolyzer. So yes, that's what's going on. And in some of our previous slide decks, we've been highlighting some of the projects that Strohm are doing. The other thing that Strohm are doing, let's be upfront about this, is this TCP plastic pipe. It's been used in the oil and gas sector where it was originally developed, and where we've got a sort of benchmark targets for this company to transition from oil and gas over to hydrogen. Actually means that this company will be EBITDA positive probably later on this year, actually, because of that sort of mix. But it sort of highlights the efforts we're putting into the energy transition between the two.
Mm-hmm. And then Alcogen, where are we going? That way.
Yes.
So what's the sort of completion date for this new production facility going to be?
Yes, well, there's another round of investment going on at the moment, which we will bring to market when that's complete. So you can see the site's being prepared now. So this factory within the next couple of years will be in production.
Right. Okay. Cool. And Hyundai's kind of funded that all the way through, is it?
What Hyundai and other investors that we can't yet mention. But the other thing that Hyundai are looking to do, this is their shipping business, is because fuel cells have got great application because they're quite heavy. But so they're sitting on in the hull of the engine room of a Hyundai ship. Will be able to generate hydrogen to go into the turbines or motors to make those move. And so, yes, they are looking at developing the product jointly with Elcogen for applications in their shipping and in time building manufacturing out in South Korea.
Great. Okay. Thank you. Now, where was the nav? No, back. There, we got the nav moves here. We should just talk briefly about NanoSun. So obviously, everything goes up in a straight line.
Yes. Yeah. So there's been a sort of a revaluation of NanoSun. We mentioned it briefly. We'll be talking a lot more about it in the end of year results and Q1 results going forward. We were a minority investor in NanoSun. We now own 100% of the successor business, which is called Swift Hydrogen. So we've taken out the key assets, we've restructured it, we've slimlined the business. We're turning it into a leasing model rather than a sort of a sale of units model. And we were in the middle of that transaction at the end of the year, but there was nevertheless a value attributed to Nanosun. But as we've slimmed it down, that reflects that reduction in NAV. And then we'll be building up that value again as we go into Q2, Q3 later this year, and we'll be talking more about that for investors at the time.
Great, that's cool. Now I'm going to do the tricky bit here and try and switch back over to my presentation again without looking everything up. There we go. Cool. Before you go though, I mean, there's a couple of sort of questions here. Firstly, this is sort of a normal listing, HydrogenOne, isn't it? There's no so there's no
main listing, yeah.
There's no reason why it wouldn't be on the Halifax share dealing website, but it may be that you just have to badger them until they put it on there. To the investor who was asking that question, although I suppose we could ask them too. And then Keith, just to wrap up, can you sort of sum up what the upside is for an investor now in the medium term? Because obviously it's quite a big discount. What do you think? How do you think it might play out as we go through the rest of the year?
What we're doing now is what we said we would do at the beginning, and that is invest into companies that have got scalable hydrogen in the industrial sector that we will exit from those positions as we go through this year. Can't say where those are, but we can say that advisors have been appointed. So that really is the main catalyst. The other one is there are some very large household industrial names that are coming into Series C, D, and E fundraisers for these companies, where there's quite considerable re-rating and a lot of credibility given to the business models themselves. Hyundai coming into Elcogen, for example, you're going to see more of that as well. So it's an unknown sector for a lot of people. A lot of people think it may or may not happen. It absolutely will happen, and it's going to work steadily and solidly through these industrial names. And it's because it's so industrial that a lot of retail investors don't see this on their sort of daily screens. But the evidence will come from these investments being made by large strategic industrial players and the projects going ahead and from our exits.
So that helps drive the NAV up. Will you be using some of the cash freed up to narrow the discount as well?
To buy back shares? Yes, we may do. It's not an option that we would exclude, but we see so many fantastic opportunities in leading this in this space. We're invited into a lot of new investments because of our early experience investing into the companies and the projects. We think there are much better returns for investors by reinvesting that capital, and even shorter runways than sort of like the 2 years we've already been at this. So we would ask investors, but we really think the best place is to reinvest, given the sort of prime position that we're in.
That's really helpful. Thanks very much, Richard.
Pleasure, absolute pleasure.
Cool, and apologies for the bit at the beginning where we sort of shuffling the slides around, but there we go. So we will be back next week. Richard will be talking to Trato on-site energy, and then we've got a sort of full lineup all the way through to May. The quarterly panel discussion, I've been trailing that for a few weeks now, so that there'll be more information being published about that shortly, but I think we can let you know who's on that now, more or less, and look out for that. So have a good week, and we shall see you next week. Thanks very much.